Hello and welcome to the AIM Summit webinar. This session is going to be one of the oldest and most important debates of the alternative investment industry. Hedge funds, active versus passive. Is active management back? This session is sponsored by FactSet. I'm your host, Zachary Cefaratti, CEO and founder of Dalma Capital and strategic partner of AIM Summit. We have an audience composed of over 30 different countries with institutional investors, family offices, high net worth individuals, and many leaders of the financial industry. We thank you for joining us. We'll be having a live Q&A session after two brief presentations. Please feel free to submit your questions in the Q&A dialogue at the bottom of your screen. As they come throughout the session, we will get to the Q&As at the end of the session. I'll be moderating the Q&As as they come in. If you're joining us on YouTube, please like this video and subscribe to our YouTube channel now. Introducing our partner for this session is FactSet, who's driven by two core values, innovation and partnership. For over 40 years, they relentlessly create open technology, delivering clean, transparent, aggregated data to their clients and designing solutions to be available anywhere and anytime. FactSet is proud to have been recognized with multiple awards for analytical and data-driven solutions, both regionally in the Middle East, in Africa, and globally. Here today with us is Pascal Wazin-Papier, Vice President and Regional Director of the Middle East and Africa of FactSet. I can also say, as a client and a user of FactSet data, we find their data invaluable. We use it for presentations, we use it for support, we use it for research. It's very critical for the hedge fund industry, and I can't speak highly enough of the organization and the team that we work with there. But without further ado, I will hand over to Pascal, who will be making a brief introduction.
Thank you, Zachary, and thank you very much for your feedback. As I said, like we always pride ourselves with the feedback of our clients. I'm really very excited to be here today for the second webinar from our partnership. If you joined last week, you would have heard me say that 2020 marks FactSet's 10-year anniversary here in the UAE. And to mark this milestone, we wanted to run a series of webinars in order to share helpful insights from market professionals. I hope you find last one interesting, engaging, and useful, and I hope you enjoy it today, and thank you for tuning in. The subject is at the heart of FactSet's client workflow as they continue to use our tools to understand their investment decision and the alpha generated in times of market volatility like the one we're seeing today of COVID-19. In 2017, FactSet ran a survey in association with Greenwich Associates that predicted passive management to become even more pronounced by the year 2020. Since we are in the second part of 2020, I thought it would be, and in an era of massive disruption, I thought it should be like relevant to ask ourselves some questions. Has the trend shifted or accelerated like we've seen in other industries due to the pandemic? How to demonstrate value in active management when there is intense competition and more fee pressure? Is passive the way forward? Or in times of market volatility, active manager selection process proves more robust? 2020 certainly puts back active versus passive debate back into the spotlight, and I'm sure it will go beyond this webinar. Without further delay, I would say, let's hear from our speakers what they think of the subject and hand it over back to you, Zachary, to introduce them. Thank you.
And you're absolutely right. The active versus passive debate is extremely relevant in these times when manager dispersion is at highs that we haven't seen for quite some time. It's my sincere pleasure now to introduce Kier, who's also going to be presenting the other side of the coin and diving into some of that manager dispersion. So when we saw that manager dispersion was the second highest in history, that demonstrates that some managers, while the average may not have knocked the lights out, some managers performed very well. And the question is, can you identify those managers? Can you select managers that will be in the top quartile or in the top decile? And here to present the argument for True Alpha will be Kier. Kier Bolli is the co-head and CIO of Alternative Investment Solutions at Union Bancaire Privée. He was Previously based in London at GAM AG for over 20 years, assuming 2 senior management functions. The first as head of alternative investments for the group, managing discretionary investment mandates on behalf of institutions, ultra high net worth family offices, managing a team of 11 investment professionals. The second, since 2018, as head of GAM's private clients and charities team, which provided multi-asset solutions for clients predominantly based in the EU and Asia. Prior to GAM, Mr. Boley worked from 1994 to 2000 as an investment director of City of London Investment Group based in London, managing emerging market equity investment mandates. He holds a BA with honors in economics and MSc in economics, and is a member of the CFA Society in UK. So, Kier, again, excited to hear some of the research that you've developed at UBP. I think that while some of your findings are consistent with Farouk's, you've also demonstrated that there is true alpha out there and have some insights in how investors might be able to identify.
Great. Well, thanks very much, everyone. I'll just pull up the screen to share. We all okay with that? Okay. Yeah, I mean, just as a starting point, we're very agnostic about investing across the alternative space. So, you know, we are in agreement with Farouk as well, is that where you can find alternative strategies that provide liquidity, lower fee structure, and rationally fit within the portfolios, it's a very valuable building block. So we look across and we invest across the full space from alternative risk premia to what we call pure alpha. And today I'll focus a bit more on the pure alpha side. But it's good to start with a bit of a background, I think. That's just really the team that's involved at UBP. But if we start here, I think this is a good way of explaining a bit that within the hedge fund industry is that sort of the left-hand chart here, stylized development of the hedge fund industry. And I've superimposed on it a typical life cycle of an industry. So development, the growth phase, and the maturation. And then within that, you can see how the hedge fund industry AUM has followed a similar type of path, with obviously 2008 being a bit of a reversal on there. On the right-hand side, then what I've done is really decompose what people believed or expected was the sort of drivers of return for the hedge fund industry. So if you look there on, say, the development stage, and this was back in the sort of early 90s up to 2000, is that because it was a very small idiosyncratic industry, then there were very few replica strategies. So the majority of the returns could be explained via the individual manager. So you could claim that's alpha in green. Now, the yellow section is similar types of alternative strategies that were applied by your peer group. So it's still an active alternative strategy, but it's more widely used. And then finally, at the top, you saw there was some rules-based factor or style-based investing. But Farouk mentioned at the beginning, around that phase, you really paid the hedge fund fees and you only got one single return, which was that sort of total hedge fund. You couldn't see what were the actual drivers, but you assumed most of it was alpha because it was, as I said, sort of quite a small cottage type industry at that point. We then went through the big growth phase, and you can see over time that the components started to shift. And then now in the mature period, we would say that a lot of the alternative strategies are well known. They're applied quite rigorously. And so that alpha component, or the pure alpha, is still there, but it is obviously smaller and is constantly under competition from other strategies to try and compete that away. So how should you, I think, look at hedge funds in that sort of phase? Then on the left-hand side, you can really see that the asset management industry and the alternatives investment industry really looked at things as a sort of split between market beta and alpha. We actually think on the right-hand side is the more rational way to look at your alternative allocation. So following on from those previous slides, you can still see at the bottom that there is traditional equity beta or premium exposed to. So it could be equity markets or it could be credit. But then that alternative space, you start to split that out. And so you can then look at factor investing or alternative risk premium, which is the first level, which is probably a lower Sharpe ratio, but has the benefits of being academically or behaviorally backed. So there is a strong theoretical backing for it, and then applies a rules-based approach. Should be liquid and should generate the diversification that Farouk was mentioning. And then you get onto that alpha part, and then you've got that liquid alpha, which is the next stage, which is active management. Could be about time horizons, how active tactically they trade. And it's that strategy which still requires liquid markets, but is more widely used or widely known. And we call it liquid alpha. It's hedge fund premium, but essentially it operates in the liquid asset class, so it's suitable to be put into a strategy like a UCITS. So it could be daily or weekly dealing. And then finally at the top is what we would consider pure alpha. And that is a return source which is specific to a manager and can't be explained away by either peer groups replicating it, alternative risk premium, or typical market beta. So concentrating on that alpha part is the alpha for us means we should be able to identify it, but then we think the alpha can only be sustainable if there is a barrier to entry to stop systematic strategies like ARP being able to replicate and access that. So on the right-hand side, you can see that when we're researching managers, we're always looking at, we want them to identify what is that alpha source and what's that barrier. So it could be asset complexity. As we said, things like distressed investing, which is, has a very high legal cost component. Could be concentration, or it could be even a niche manager or a skill in that infrastructure approach. So for us, we think alpha is around, but it needs clear barriers to entry to stop peer groups and wider systematic strategies coming in and competing that away. When you're looking at investing into the alternatives, then one of the people often overcomplicate the sort of investment strategies, and we tend to look to classify the strategies via 3 types of return profiles. And that can be linear, convergent, divergent. Now, linear on the left-hand side are really strategies that use a significant amount of market beta to generate their returns. So they give you a left tail type event. They can do well when markets are doing well, but when your markets are under stress, they'll tend to give you that drawdown. And that linear is very well known. We think it's the area where alpha has been the most competed away. You then look at convergent, which still is left tail, short vol, but that will tend to work well when there is reversion to mean. So there are a number of strategies like fixed income RV. And on the far right-hand side are divergent strategies, which actually do well in periods of stress. So if you combine that convergent, divergent together in your alternative allocation, you should get an attractive risk-adjusted return, diversified to your traditional assets, and obviously doesn't have that stress beta within the portfolio. So the best way, and Farouk had covered this a bit, and I've just looked at the last 24 months with those different types of the three return profiles. And you can see in grey is really the equity risk, and you can see that in Q4 to 18, and obviously in March this year, we had two periods of market sell-off. And then you can look at the different linear, divergent, and convergent. So at the bottom, you can see HFRI equity hedge, which is linear, as I said in blue. You can see there's quite a high correlation, exactly as we were saying, to equity risk because of that linearity in periods. And you can see that they sold off to a similar type of level within each of the big corrections, but subsequently bounced back, as you can see. The convergent strategy would be the gold area, which is convert arbitrage. And again, you can see there, they are mean reversion in strategy, but under periods of stress, they'll still give you a bit of that left tail, and you can see again that sort of relationship. And then finally, the HFR macro managers, which are divergent, which should be long vol, and should be able to provide you protection in these periods if they follow their correct return profile. You can see that they have performed better in the periods of risk off, and then have actually had a strong bounce since April because of valuations. So to conclude, just on my part, before we get on to the open Q&A, then I think investors should be open to all alternative strategies. It depends about your fee budget, your liquidity profile, and your holding period. So you can go from ARP through to pure alpha. Pure alpha does exist, but it's smaller, it's always under pressure, and because it's pure alpha, then you will have to pay a higher fee structure for that. And then in general, there's the final 2 points, but also I think for active managers, then the headwinds that they've been facing for the past 7 to 8 years are beginning to subside. They might not reverse and become a tailwind, but it is becoming easier, I think, for the good managers within strategies to stand out from the average. And at that, I'll go back to the host.
Excellent. Always thought that the term hedge fund was a bit of a misnomer. And I always thought that the industry would be better off if we just dropped the H and referred to ourselves as hedge funds. So I think that plays to a point that Kier has highlighted is, being able to identify that edge, not only identifying managers who are able to harvest that edge, but markets which might give way to having an edge. So Kier, do you mind sharing with us, is it possible to select top quartile managers and strategies, and what are some of the ways that investors can approach making sure that they're not just overpaying for factor or alternative risk premia or betas that they could get on the cheap?
Yep, I mean, if we take, say, an institution like a hedge fund, like a pension fund, so say that has already got exposure to traditional assets, then our base case would be first to really build with, say, risk premium or style approach, because that keeps the fee budget down. You can then really ensure you haven't got overlap between factors and you're not paying for additional costs that they already are exposed to. So the first thing would really start at that level, and then where you want to save your fee bucket or your most expensive, and that is really then to identify, well, which satellite type pure alpha managers would you add? If you look at trying to identify those pure alpha managers there and saying, well, can we build a portfolio of the top quartile managers? Then I think you can, but the most important is to run a focused portfolio. The real danger within allocating to hedge funds over the past probably 10, 15 years has been over diversification of these managers. So you want to feel safe that you've diversified by number of managers, but really you're actually just introducing commonality of factors, which we've just said. You know, the pure alpha is quite rare. It's quite sustained within a small group of managers. So making sure you don't just create offsetting factors and paying high fees for that is very important. So concentrated portfolio, you should be able to identify that they have something that's unique to them, and that comes through the qualitative side of your investment approach. But then the most important, and that's the more in-house discussions within the team, is why is it sustainable? You know, and we're not interested in some manager who has a great performance that can last a year. We're actually looking at, well, if you're invested with them for 3 to 5 years, what sort of edge have they got to everyone else? And if you're in the very short end systematic type approaches, you know, it's about budget and R&D that they can apply. And it's sort of R&D, background track record, but then because they're so short term, they are so capacity constrained. So you want to really focus in that space. And then if you're moving out to, say, distressed investing, where we had been underweight for the last, you know, probably 7, 8 years. And then that's changed as of the beginning of this quarter for obvious reasons. Then with that, it's about proven track record through a number of cycles within distress, not that they're suddenly all trying to launch distress funds now. And of course, it's in a space where you think the expected returns from fundamental principles are at their high. And that's when you think that, you know, you are supportive via the underlying factors that will help you.
So would it be fair to say, Kier, that true or real true alpha shouldn't exist in a market that is efficient, right? A market that is perfectly efficient shouldn't have that true alpha. It may have some alternative risk premia, but true alpha should be hard to find because it should be arbitraged away effectively. So would it be fair to say that one of the good places to find it is to look at markets that are inefficient, again, that have either those barriers to entry, that may be new markets. Again, we identified a lot of inefficiencies in cryptocurrencies where there was true arbitrage, potentially retail dominated markets, again, some emerging markets where you don't have as many institutional investors competing away alpha. Are those good places to find them? And what other markets, or what are some other examples where you might find that kind of durable inefficiency, or even a temporary inefficiency that can be exploited for a period?
Yeah, it's exactly that. It's usually, just as we said, it could be the markets are difficult to access. And then you really can capture the sort of illiquidity premium through time. So of course, these pure alpha hedge fund managers will be pushing, you know, quarterly liquidity or greater, so they can benefit from that sort of mean reversion over time of value. So one is holding periods will be important for the style or strategy. The other now, which is extremely differentiates others, is the ability to access leverage that is sustained. So, you know, pre-2008, a lot of strategies could apply leverage. Post that, it's much harder and more difficult. But that actually means the groups who could apply leverage in, say, fixed income RV, in micro rates trading, have generated exceptional high risk-adjusted returns because there aren't many competitors against them. So there is always that cyclicality of returns. So you need to know, are we close to a turning point in the factors that support the strategy? But also what structurally might have changed. And as you said, it can just be niche markets where you really do have a specialization through experience, and it's difficult to replicate not only systematically, but even peer groups who just don't have that skill set.
Another question from the audience from David Keswick for Kier. In this type of environment, would you expect macro funds to do better than equity long short? And can you give examples of why and possibly some anecdotes of some of the performance that you've seen in the macro space?
I think what we like to do is really separate those out. So when you're looking at equity risk, the characteristics of equity risk are very unique compared to, say, fixed income or other diversifiers in your portfolio. So within that, we tend not to compare, say, a macro relative to an equity long short manager. We would say, you know, your equity long short structuring should be in relation to you know, other factors within equity markets. Now, with that caveat, then if you're looking at sort of macro versus equity, of course, global macro managers do not trade individual single stocks to any great extent. They'll trade equity risk via futures or indices to execute their macro view. What I think is the two real differences is that you should think of equity long short as being really short vol. So in normal conditions, you know, equity markets tend to trend up. They should do well, but when you do have a short-term correction, they will tend to struggle. Compare that to a macro manager, which through their positioning, mainly through options and futures, should be quite long vol. And they carry large amounts of cash on their portfolio. So in those periods, you should expect them to outperform and protect the portfolio. So it then comes down to, well, what's your view really on the outlook of asset classes going forwards? And if you think that volatility is going to return to equity markets to the historic levels, so you're talking 15 to sort of 17%, then obviously the Sharpe ratio of equity investing will drop back down compared to its very elevated level it's been on. And then I would think macro will start to perform well. Conversely, if you think all this central bank activity that can continue to suppress vol across asset classes, then that is a real headwind for global macro, because obviously they're long vol and vol keeps on getting cheaper, where equity strategies should perform better. So unfortunately, it's a little bit about your own view of what way asset classes are going.
You know, just to summarize, I think, again, for all of us that are investing in hedge funds, and particularly those of us who are paying active management fees, it's important to look closely at your managers and seeing if they are delivering that true alpha or just delivering you some of those factors. Because again, with some of the products that exist today, you can buy those factors much more cost effectively, much more efficiently, and with much more liquid and transparent approach. One final question. We're out of time. I can't believe it's already been an hour. This has been such an interesting webinar. One more question for Kier. Farouk touched upon the fact that actually one of the factors that's been always hotly debated, especially recently, the value factor has been a challenge. Why in general has it been a difficult year to date for alternative risk premium strategies, in your opinion, Kier?
Yeah, I mean, it's really been this, just mentioned before, it's value versus growth. And of course, equity market neutral is one of the purest forms of this value versus growth within risk premia. And it's not just been, I think, this year, it's been a headwind for many of the big players within the space for probably 2 to 3 years now. But over the long run, it is, you know, it has strong fundamental principles, and over the long periods has good demonstration of performance. One of the big headwinds for it is, of course, you can look at the correlation between that and real interest rates. And of course, the real interest rates reflect sort of a low growth environment. So of course, investors in equities have really chased wherever they see some growth, and that's been in the tech sector. But I think, you know, if we start to move in a period where we move into a more inflationary environment, and that will mean real rates start going negative, but then yield curves starting to back up, I think you then start to get that rotation or the reassertion of value over growth. And so that's some of the things we're looking for is, you shouldn't give up now on the value versus growth, especially within risk premia, because you're always looking at forward expected returns rather than what's happened. And we do think that sort of COVID was the final deflationary impulse that the world has suffered since 2008. And now you have fiscal stimulus along with monetary stimulus, and clearly the central banks are aiming for overshooting on inflation. You will start to see, I think, rotation between certain styles and sectors.
Well, thank you so much, Kier. Thank you so much, Farouk. This has been a very interesting session. I have so many more questions. I wish we had more time. Again, this is a debate that will continue. I think that over the time to come, we will see potentially some of these other factors play out, and certainly it will be interesting to see the value factor make a comeback. Knowing some of the investors actually in this session, I know that there are several value investors that are fighting the good fight and waiting for the return to that value investing. Thank you to everyone who attended, and thank you for any of the questions that did come through. I'm sorry that we weren't able to spend more time on the session, but Pascal, I would like to thank you first and foremost for hosting this and making this possible from your team at FactSet. If I could just hand over to you for some closing remarks before we end the session.
Yeah, as we said in the beginning, I'm sure the debate will go longer than just 1 hour, and we can see that we ran over. I would just say, like, if you want to find out more, there's also a lot of literature and a lot of ebooks, complementary ebooks, that you can find under the Insight tab on our FactSet website. It's written by our FactSet specialists through the learnings that they had over 40 years serving asset owners, asset managers, private equity, and hedge funds. So please go ahead and download them. And I would just want to thank you again, Kier and Farouk, for attending today and for the insight. Thank you, Zachary, for moderating. It was very interesting, and thank you for the audience for tuning in. And I hope to see you all next week for our last webinar.
Absolutely. Next week, we will be having the last webinar that's sponsored by FactSet, which will be, again, another interesting session, a very hot issue and hot button topic at the moment, which is focused on impact investing and ESG asset allocation. This is going to be taking place on Monday, the 28th of September at 4 p.m. Gulf Standard Time, 2 p.m. CET. That will be led by none other but Peter Rockefeller, board member and vice chairman of Rockefeller Philanthropy Advisors and managing director at Brock Capital Group. Remember, if you're joining us on YouTube, please like this video. Please subscribe to our YouTube channel. Again, Farouk, Kiera, I can't thank you enough. And of course, thank you very much to our sponsor and to everyone in our audience for joining us today. Thank you.